So what we have here is we making higher highs, higher lows, higher highs. And I like to call this areas my key levels, which I will be explaining in a second. So what happens here is that price will come down to this area and reverse, where we have our continuation order block and our key level. Now that's not always the case. To using this method, price must always have some liquidity to take out. What do I mean by that? Keep in mind this strategy works on the 4-hour time frame. Well, let's look at this example we have here. We have equal lows, which means we have liquidity below those lows, meaning there's stop losses from other traders who took advantage of this. So what price does it comes down to this area and fill up all those stop orders from other traders using this continuation order block to reverse and continue its trend. So this can also be any type of liquidity concepts, like for instance, we have a swing low and trendline liquidity, which I will be explaining in other video. Now let's talk about where to put your stop loss. We can put our stop loss just below the wicks of the order block, presenting us with a 1 to 3 risk to reward ratio. Overall rules for this strategy: look for a continuation order block. For the continuation order block to be valid, it must break structure, must have liquidity to take out. Now let's look at a real chart example. So as we can see on the chart, it's basically the same thing I was explaining. By the way, this is a trade I took. Now looking at this chart, we have a continuation order block. The continuation order block has broke structure, creating our key level. We have a bunch of liquidity to take out. And as soon as price came down to this area, price immediately reversed. Let's look at another chart example. Again, same thing. We have a continuation order block. It broke structure, creating our key level. We also have liquidity to take out. And immediately price touched this area, it reversed. Thanks for watching and see you in the next one.